So it's now 2017 and another year of market returns are in the books. And do you realize we have now gone 17 years without an annual decline of even 1%? In 2009, we lost 0.75%. In 1999, we lost 0.09%. Yet insurance salesmen are still out there spreading all this fear about the stock market being a roller coaster ride or a trip to the high roller room in Vegas. Whenever an advisor starts preaching about the 2008 market crash as rationale to sell you an annuity, this is proof positive that you are being lied to. Do you do business with people who you know are lying to you? I sure don't. They're presenting a straw man argument, a false choice. Insurance salesmen never, ever talk about the Ibbotson 2872 rule, which is they did the study from 1970 to 2010 and found out that the lowest risk allocation was 72% bonds and only 28% stocks, not 100% stocks, not 75, not 50%. And this is nothing new. This isn't some recent phenomenon or anything like that. Bonds have always been slow, boring, and consistent, going all the way back to the Great Depression and beyond. And with history as our guide, if you're retired or retiring soon, and you want the absolute lowest risk allocation so that you don't run out of money while taking out 4% per year, 2872. There you go. And since 1938, a 2872 portfolio has never lost more than 5.91%. And that was in 1969. And look at what happened in the following 2 years. Up 13%, then up 11%. How about 1974? Down 5.82%. The next 2 years, up nearly 13%, then up 18%. How about 1994? Down 5.42%. The very next year, up 27%. When things overshoot, they snap back in the other direction. Yet I read posts from insurance salesmen who cherry pick. For example, this guy, he's talking about how volatile 20-year treasuries down 21% in 2009. In reality, the Barclays Aggregate Bond Index was up 5.93%. 10-year treasuries lost 11.2% in 2009. Stocks were up 25.94%. There you go. Now, what about 1929 onward? If you had the absolute worst timing, you entered retirement starting in 1929, and you were taking out 4% per year pegged to inflation from your nest egg. Did you run out of money after 30 years? No, of course not. And if you're thinking, well, it got kind of scary right around here in 1932, well, not really. In 1931, we averaged negative 9% inflation for that year. In 1932, we averaged negative 10% inflation. In other words, deflation. Yes, your nest egg got down to about $75,000, but goods and services were getting cheaper and cheaper, so it didn't matter. Any retiree who desired low risk and was properly diversified into bonds didn't jump out of any window to their death, okay? And by the way, it's not even realistic to go back to this era because the stock market of today isn't what it was back then. You can pause the video if you like. So then we have deceptive insurance salesmen telling people, oh, 4%, I can give you 6%. I can even get you an annuity that grows 10% per year for 10 years. And this is a lie. They're being ambiguous with the word return. In the case of index annuities, they're only talking about an accounting ledger called an accumulation value or income base or roll-up rate or similar terminology, not the same as annualized return on investment. In reality, with all index annuities, you can expect a return on investment of between 1% and 3% moving forward. Not 6%, not 7%, 8%, 9%, or 10%. If you don't believe it, click the link in the description below this video for a better understanding. So when you call out these insurance salesmen with historical data, the very last line of defense that they use is to sell you fear. The way to sell something to somebody is to scare them. They'll say that an annuity is guaranteed. Are stocks and bonds guaranteed? First of all, you can make the same stupid argument about CDs. CDs are guaranteed. Why would you invest in stocks and bonds? Well, because CDs only pay like 2.25%. You're bearing too little risk. Have you heard the phrase, never bear too much risk or bear too little risk? So the question is putting 28% in stocks and 72% in bonds bearing too much risk? Hell no. Is a 28-72 portfolio guaranteed? No, but does it need to be? No, because we have 90 years of stock bond market return data that gives us trend lines by which we can make reasonable forecasts. And think about this, for a commission-based advisor to say to you stocks and bonds are not guaranteed without showing you historical data and charts for you to decide for yourself if it matters or not that stocks and bonds are not guaranteed, they're being dishonest. They're trying to make the decision for you. They're trying to make the sale, the high commission annuity sale. And by the way, annuities, not guaranteed either. So chew on that one.